Hey there, class. Uh, this is a video log of the Class 4 homework. So there was only one problem I wanted you to work on ahead of Class 5. And I'm going to go through the problem. I'm going to show you how I would solve it using the Excel template that I showed you in Class 4. And that way you can reproduce it at home if you want to. Again, like I've done with the other homework assignments, I'll walk you through this and I'll post it, but I want you guys doing the assignment on your own first, because trust me, just looking at my solution is not going to help you. I'm only posting this to the extent that you're getting stuck and frustrated. Then watch this and see what you've done wrong and try to challenge yourself to fix it. Okay? So the Class 4 homework assignment that we're going to go through is the one I have up on the screen here. And this is the one that has a company with balances as of 12/31/11, and we're doing the provision for the year end at 12/31/12, and so we show the balances of our temporary items at the beginning or at the end of the prior year as well as at the end of the current year. Okay, so like I said, I'm going to do this solution in Excel, but this is the just to make sure we're on the same page, this is the problem that we're looking at. Okay, so I'm going to start with the model that we talked about in Class 4, and I'm going to start with a model that's totally blank. So let's just go top to bottom in the homework assumptions and work this through. So the first assumption is that for the year ended 12/31/2011, the company accrued income tax payable of $200,000. Okay, so that means that as of 2011, so now I'm on my accounts page, I had a $200,000 beginning balance of my payable. Okay. All right, so I've just pushed that into the model as my beginning balance. It's not a calculation per se, it's just a given. Okay, but I want that to be on my beginning balance because ultimately I'm going to try to identify my correct ending balance. Okay. So the second fact was that I had a few temp items. Okay, so I'm going to enter those in the Deferred tab. The temp items that I had was, as of 2011, I had $200,000 of bad debts. Okay, and so I've entered that as a positive number because that's a future deductible difference, and once tax affected would result in a deferred tax asset. I had an inventory reserve of $150,000, and that's the same thing from a directional standpoint, that I've added that as a positive number because in the future when I scrap my inventory, that will be a deductible item. The next item I have on my assumptions list is prepaids, and at the end of 2011 I showed a temporary item of $25,000, and that's going the opposite direction because for prepaids I'm deducting it for tax before I expense it for books. So in the future, when books expenses that $25,000, I won't get a corresponding tax deduction. And then lastly, for fixed assets, I have a $500,000 book value in fixed assets. And later in the assumptions page, my tax value is $450,000. So that means I have a taxable temporary difference of $50,000. Okay? So that's what I should have as of the beginning of the year. Okay? And the assumption is that my tax rate is 35%. So I have deferreds of $96,250. And let's see what else I have. I have one other deferred, and that is, it looks like I had an R&D credit carryover of $50,000. So you'll notice I'm inputting that below the line, and so I've taken my $96,250 that I just calculated, I've added the $50,000 for my R&D credit, so my total deferred as of the beginning of the year are $146,250. Okay, so let's make sure that at the beginning of the year I have that balance. Okay, So now my beginning of the year balance, because this is what I assumed I already calculated on my provision last year, was the $200,000 of payable, which I was told in the example, plus the $146,000 of DTAs that I've calculated. Okay. Let's just look at the example and see if there's anything else that's been done. Okay, so it says that on September 15th of 2012, I filed my tax return and I paid my liability. There was no return to provision true-up necessary. So I paid my liability. That must mean that I'm going to stick here on my extension payment line that I paid my tax. So that's going to cause me to debit payable and credit cash. And like I was saying in the last class, now I can prove my payable balance after I've trued up my 2011 accounts, and it shows 0 because, you know, I filed my return, I paid my tax, I'm done, nobody owes anybody anything, I shouldn't have a payable after I make that adjustment. And I've calculated these deferreds as the ending 2011 DTAs that I carry into 2012, and you can see that in the second to last bullet on the page in the assumptions, the assumption was that there was no return to provision necessary. So that's artificially simple. Okay. All right, so now if I move on to my provision calculation for 2012, I have pre-tax income of $2.5 million. So that's income. And remember, this column right here, that's my payable column. So that, because I have income, is going to cause a tax liability. So I put in $2.5 million. There is a gross credit, because before tax, what I'm going to be doing is creating a tax liability, meaning before applying the tax rate, this item is going to create an increased payable. The next item in the calculation of the 2012 provisions is meals and entertainment. So there's $150,000. So that means I have to add back $75,000. So I entered that as a credit in my payable column, and the offsetting debit is to provision. The next assumption is penalties. The penalties are $22,000. So I'm going to again book that as a credit, and that increases my provision. And let's see, the next little bit here, I just got to figure out from my temp items what my movement is. So my bad debt reserve went from $200,000 to $167,000. So that's a decrease of $33,000. All right. So my bad debt reserves, that's a decrease in the reserve. That means it's a deduction to me, which means I'm going to debit my payable. So I'm going to put a positive number in there, $33,000. And my inventory reserves, it looks like I got to unhide some rows here. And I've done that on purpose because I don't want to just start entering on random rows in this tab. Otherwise, it won't flow to the deferred tabs because right now they should be linked. So I've entered my current book tax difference related to bad debt reserves already. And now if I go to inventory, my inventory reserve actually went up by $85,000. So that means if it went up, there's a expense in the book number, I mean the book PBT on line 8, that I won't be able to claim a tax deduction for currently. So that means it's going to increase my payable by $85,000. So I've shown that as a credit in the payable column, and it's a debit in the deferred column because in the future I'm going to get a tax deduction. And the prepaid balance went from $25,000 down to $23,000. So that means that books is taking an expense that I don't get to deduct, and so I need to add that back as well. So I've added that as a credit. Okay. All right, so depreciation. Okay, depreciation's a little tricky. It looks like the depreciation went from, if I look at my book depreciation, it looks like my accumulated book depreciation went from 500 to 600,000. So that means that there's book expense during the year of 100. And if I look at my tax depreciation, it looks like my accumulated depreciation was 550. And now it's 700. So it looks like my tax depreciation was 150. So it looks like depreciation, when I add all that up and I calculate my book tax difference, it looks like there's a $50,000 favorable current year adjustment that I'm reducing my tax liability for in the current year. But that just means because this is a temp item, that will flip in a subsequent year. Okay, so I think I've captured all the differences, and my taxable income is 2601000. It looks like I have credits this year of 24,500. But this one's a little tricky because I have a large tax liability. So not only am I going to be able to use the credits that I generated in the current year, but I'm going to be able to use the credits I generated in the prior year as well. So the total credit I'm going to use is the 74,500, right? That's the sum of the 50,000 I was carrying forward and the 24,500 that I had from the prior year. So now you can see my row is not working automatically, so I need to make it work. So if I was using my 50,000 from last year, I would expect that in the deferred movement column, I would move the 50. And hopefully what that does is it takes the balance of my deferred that I had at the end of last year and it reverses it. And the reason is I need to reverse it because I'm going to use it, right? That's part of my 74.5. And the other 24.5, that's a current year credit, and so I would expect that to reduce my provision. So I would take a provision benefit for the current year credit that's generated. I'd reduce my deferreds for the prior year credit that I had already established a DTA for. I'm going to credit my deferreds to reverse that. And then I would debit my payable by 74.5 because that's the total amount of tax that I'm going to save. And then this 50,000 here, that's just an errant formula, so we should just delete that. Okay? So that's my balanced row there related to credits. And after I've used my credits, I have a payable of 835. Okay? So as you can see in the last bullet, we assume that there's a tax rate of 35% and there's actually no state taxes. So I've just zeroed out the state tax rate, and there's some numbers over here, but there's no state tax being calculated. So this example is pretty straightforward because we're really just dealing with one jurisdiction. And then as one final check, if I sum those across, those sum to 0, which makes me think I have a balanced provision. Okay, all right, so my payable tab is done. Now, if I go over to my deferred tab, now I got to see if it's working. Because in large part, this is automated, but it sure make us feel better if we knew that this thing was working correctly. So bad debts, I had in the example that my end of year balance was 200,000 from the prior year. And we know that my end of the year balance from the current year is 167 because that's stated in the example. And this change, you can see that's automated. That's just pulling from the payable tab, the formula is. And so this is working great, right? I inputted my prior year balance. My change, I inputted on the payable tab, but it's flowing to this deferred schedule, and it's causing that deferred to now reflect my 12/31/12 ending balance, which is exactly what I want to have happen, right? I want to say that at the end of the year, that is my future deductible difference. It's working exactly the same for depreciation. So at the end of the year, if I compared my book value and tax value of depreciation, My book value is 400, and my tax basis is 300. So my tax basis is lower than my book basis by 100, so I should end the year with a taxable temp item, and I have that. My inventory reserve works exactly like my bad debt reserve that I just showed you a minute ago, so that 235 ties out to the example. And so does the prepaid. And then lastly, like we just spent a minute ago talking about, the R&D credit reserve that I had at the beginning of the year, it is now gone because the current calculation used not only the prior year balance I had, and that's what this schedule is focused on, is it's saying you had a deferred at the beginning of the year, but that's gone, you've used it. Our current calc used not only the prior carry forward, but also the current year generated calc. Okay, but all this tab is concerned with is removing that carry forward. So at the end of the year, then, we have deferreds of 97,650. Okay? All right, so if we went to our account tab, there's not going to be anything on the deferred state tab because, again, we're just dealing with one jurisdiction. So if I go to my accounts tab, this is automated, but let's just see if it's working right. So the federal provision is booking a payable to a credit of $835, and if you remember that from this tab, that's just pulling that number over. So that's what we'd expect. And the deferreds, it's pulling a credit of 48.6, and maybe more important than that, it gets me to my ending deferreds of 97. And that 97, that's this number right here that we were just talking about. That's exactly what we want the ending balance to be. So that account tab is working perfect, right? We adjust our prior year deferred of 146, and we get to our ending of 97. And then finally our balancing entry so that this row foots to 0. It doesn't look like it foots to 0 only because it's double counting the payable. So if I just blocked that, then it's summing to 0. So that balancing entry of 84 of our provision, you know, that's what we calculated here as far as the tax expense as well. Okay? Okay, so that's the account tab. And now if we roll over to the rate reconciliation tab and the footnote tab, all right, I want you comfortable with how on this table, right, so this is the first table, and what this is trying to do is it's trying to explain here what your current provision is, and here what your deferred provision is, and the sum of those two is your total provision, which is that 884. Okay, and this is pretty straightforward because there's no return to provision, so all that 835 is the current number, the current liability that comes off the payable tab. And this deferred provision is simply the change in the deferreds, right? 146 was the prior year balance, 97 is the current year balance, 48 is the flux. And so if you think of, well, gosh, I need to move my deferreds by 48 grand, I've got to take an asset of 146 and lower it. That means I need to credit my deferred taxes and debit expense. And so the 48 is an expense, it's a debit from a journal entry perspective. Okay. And then from a rate rec, I have my 2.5 million of income pre-tax, and I would expect, using a 35% rate, that to tell me I have 875 of expense. And this one is easy peasy because I have no state tax. So I enter my I enter my two perm items, and those, you can see, they're just linked to the payable tab. And calculating at 35%, I get those effects. And then finally, I have a credit, and you'll notice that that credit is just the current year credit. And the reason is that even though in the current year I'm using not only the current year generated credit, but also the prior year carry forward, that prior year credit, that 50,000, that was already benefited. I already booked a provision benefit last year to set up the DTA, right? So if you think about, well, what entries did I book? I mean, let's make sure we get this right, because this is semi-important here. So if you thought of the entry that I must have booked last year for this, last year I must have debited my DTA for the $50,000 credit, and then I would have credited my provision. Okay, so I don't need to benefit that credit again because I've already benefited that. And when I run it through my provision, now that I use it, I'm going to shortcut this a little bit, but now that I use that credit, really all I'm doing is I'm saying debit payable, right? Because I'm going to reduce my tax liability by that 50 grand. And then I'm going to credit my DTA, right? And you can see that there's no provision entry in that. And I know I've taken this entry, and instead of booking it as a gross current expense item and a gross deferred expense item that offset, I've just shown the net balance sheet entry. And my only point in that is just to prove that, notwithstanding on the payable tab you saw that $74,500 credit, the only provision benefit this year is the current year generated credit. Okay, and so that's why we get the 24.5 of provision credit. Okay. And then at the end of the day, we have the total provision effect, which is the 884 here, and we've reconciled our rate, right? And that 884 ties to this 884, and so that is your proof, right? At the end of the day, if your rate rec, if your rate rec ties to the 884 that you've proven as your ending balance for the provision, you're in great shape. And then from a balance sheet perspective, we went to this balance right here, this 97, and we proved that to our deferred schedules. And this payable balance right here, we've proved that to the current calc, and I think the assumption in the problem was that there were no payments. Okay? So, anyways, that's the solution to the homework. Best of luck. Talk to you later.